Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'm going to be your host for about the next 15 minutes here. We're starting anew in the week, I guess. Last week we did a few trades, looked at an S&P 500 index trade, and I had that trade on my account, and I salvaged it. I ended up losing 75 cents on the trade. Markets are down a little bit today, and kind of wanted to wait to see where we were going to start the week. We have some just interesting data overall, and I think the biggest surprise is what's going on with the Fed funds futures and the futures market as far as the Fed is concerned. And looking at the Fed Watch tool on the CME, it's saying that there's a higher probability now that we're going to have a 50 basis point cut than we are having a 25 basis point cut. So that has just kind of whiplashed in the markets. And I still want to do a VIX trade. I want to hang in the VIX index. It is up a little bit today. The VIX is up a tad. And I'm going to do something going into October. It's a little bit further away than I would like. It's 30 days away in the VIX index, which is just a heck of a lot of time. But I think I want to put the trade on today, and we'll watch it. And we'll, with the VIX and with butterflies that we'll be doing, we do have a chance to modify the trade, but it's more of you want to put it on for the right price and then manage the risk by either getting out at a certain price if you'd like to, or just riding it to the end, because so much happens at the very end in the VIX, and it's cash settled index. So with me, it's just more about setting up the trade initially. So we're going to spend some time looking at that today and setting up a VIX trade that will get us long volatility, an increase in implied volatility going into October. Now, the last trade that we did worked out excellent. I'm going to do a rinse and repeat of that strategy, but we had the VIX at a little bit lower level, and I don't think you can't fool the market twice. But this was heading into September, knowing that the seasonality of the VIX it usually implies that in September and October implied volatilities increase. And we had that happen. Honestly, it was a holiday. The first day in September, the first normal trading day, that Monday was a holiday. And then on the very next day, we had volatility in the market. Both Tuesday and Wednesday, the marketplace skyrocketed. We were long a VIX butterfly, and that trade, almost doubled overnight. At one point in time, I actually, on part of my trade in my own portfolio, I was able to triple up on the trade, and I want to go back to the well and do that same trade again. I wish the VIX was trading closer to the 15 level like it was when we first put it on, but it's not. So we take what the market gives. We see the VVIX, the volatility of the options in the VIX index, the VIX of the VIX, if you will, is trading up northward of 108. So we got some vol premium. That's not extremely high for the VVIX, but it's definitely on the higher end of the range. So vol is elevated in the VIX options, which is a thing, I guess, that you can say. And when vol is up, butterflies are cheap. So ideally what you'd like to happen, which won't happen in our case because we are going to be bearish on the markets overall and bullish in the VIX because their inverse relationship that the VIX has to the markets. And when you put on a butterfly and you want implied volatility high when you put it on, and you want it to come off if you're correct on your forecast and the underlying goes towards the middle strike of your butterfly, that is the best case scenario. Well, in this instance, we want to make our butterfly wide enough that the pricing of the options and the implied volatility will be far enough. We'll have a wide enough spread in a low price index that it will try to help us pay it off if you will. I'm not saying that very well, but let's just get into the trade. And when we look at the profit and loss calculator, I'll talk a little bit more about that and see if I can explain that a little bit better. It makes sense in my head, but I heard my words, and I don't think I did a very good job of explaining that. So I'm going to start inside the options playbook to try to explain what that butterfly is. And actually, you know what? Let's start here, just because I found this to be very intriguing. September and October are always just interesting months in general. And so here, let's run to the, I don't always bring up the Fed watch tool on the CME, but I'm going to show it to you right now. Okay. So very surprising to see that on the September 18th Fed meeting, which is 2 days and 2 hours away, based off of the latest news that we had in the economy, this futures contract, which is right now currently at, we'll just look at the bottom number, 525. And here it's saying the bottom is 500. So the way that you'd read this chart is it's saying there's about a 39% probability, based off of where the futures are trading at right now, that the Fed is going to lower the Fed funds rate by 25 basis points. Then if you look at this number, 475 from 525, that's 50 basis points below where the current market is at. And they're saying there's a 61% chance now that there's a 50 basis point hike. Now, since I always take a peek at this, but since I've taken recently, I have not seen this probability higher than the 25 basis point probability. And you can see that by just scrolling down, it shows you, 1 day out, 1 week out, 1 month out. So a month ago, there was only a 25% probability that they would cut by 50 basis points. Now we're showing a 61% probability, just a huge jump in the possibility of a 50 basis point cut in the Fed funds rate. So we're going to have a fun market over the next couple of days waiting for this meeting. And then we go out until November, and the next meeting is going to be in November 7th. So it will obviously depend a lot on if they do 25 or 50 this time around. They're saying basically 100% chance that they're going to do something, that they're going to cut at least 25 basis points. And then they're showing the high probability that they're going to cut again. So they're saying that the most likely scenario right now is that it will be at 450 on that bottom number, which is, from where we're at right now, that's, let me see. So this was 475. Okay, so that would be 25 basis points lower than where the market is predicting to be at right now. So this is taking everything into account, and they're saying there's another cut that's probable looking at the November Fed funds meeting, Fed meeting, not Fed funds, Fed meeting. All right. Struggling with my words today. All right. Let's now come back out a little bit, and I am going to find options playbook. And let me get this up. Okay, so here you go. Inside the options playbook, we're going to look at butterfly with calls. And I always like to try to explain this strategy as much as possible because it's a fairly advanced strategy, and it's a little bit something different. And the way, especially in the VIX index, and just in case you get any black swan event or just huge move up in the VIX, which can happen at any moment in time, but definitely can happen in September and October. And by charting it charting the VIX index over the last 20 years, you see that most of the time in September and October, the volatilities increase. I don't have a rationale behind it. It just is one of those things that is true until it's not. And that's the way that I approach it always in September and October. So if you're buying a call at strike A, you sell 2 at strike B and buy 1 at strike C. Okay, scroll up a little bit. Now, what we're going to do is stop short on this trade. Okay, this is our money driver as far as our butterfly is concerned. If you buy just a simple trade where you're buying a call at strike A and you sell one at strike B, that's just a long call spread. That wants the market to get to strike B. The second leg is what pays for our long call spread. And that wants the market to be below strike B. So what you're doing here is you're selling a short call spread, selling another option contract. So we're going to end up selling 2 at strike B, and then buying 1 at strike C. All right. That wants the market to stay below here. Okay. This brings in a net credit. This is a net debit. You combine the two, and usually you get butterflies done fairly cheap relative to just buying options outright. Okay. So what happens if we stop short? What happens if we don't do as wide of a credit spread as we do a debit spread in our butterfly? Well, that means we're not going to bring in as much of a credit. So instead of strike C, let's call it strike B and a half. Well, I got, for lack of a better way of saying it, and we buy something that's right in here. Well, we're not going to receive, this is going to be a more expensive option contract, and we're not going to receive as much of a net credit. Oh, well, we've already lowered the price just trading in general by doing a butterfly, by doing a 3-legged trade. So we're just going to have to pay a little bit more for our butterfly, but that's going to open up this wing, and it's truly going to modify the butterfly and say that if the market takes off and it goes above strike B and beyond to strike D, strike E, strike F, well, we're still going to be profitable on our butterfly as opposed to having this downside risk. So we pay a little bit more upfront, which in the VIX index, butterflies are fairly cheap because the volatility is so high on the option contracts. So it doesn't cost us that much more to have unlimited, unlimited profitability and unlimited chance of profit anywhere above strike C and beyond. That simple. All right, so let's jump back out. Let's set up the trade, and I'll see if I can explain all these concepts in a different way, looking at the Tradier Pro software. So this is the only trade that we're going to look at today. If you have any questions about anything else that you would like to talk about today, we can try to address it. And I see that Wayne's already got a question in here. And I guess let's do it before I get into the actual VIX. All right, let's put that question up. Well, we're already backed out. What is the difference between the butterfly and the iron butterfly? Okay, well, the big difference between the butterfly and the iron butterfly is you are doing a short call spread and a short put spread. So a best way to think about an iron butterfly is that you're really just taking an iron condor and turning it into a butterfly. An iron condor means that we're selling a call spread way above the market and we're selling a put spread way below the market. If the market stays within the range of the short call and the short put, it's profitable. But the iron butterfly, if you just come in and you make that short put and that short call the same strike, you end up with something that looks like a butterfly. The big difference here is that you bring it in a net credit to the account, but you are going to have a margin requirement because you are short 2 different spreads. One is a call spread and one is a put spread. So instead of dealing with that, most people would rather do butterflies where you just pay the net debit, and that debit is your risk, and then you don't have the mixed option contracts, right? You don't have part of your trade being calls and part of your trade being puts, which can be confusing. In our situation, we're just going to do all calls. So that's the big difference between those two. If we have the VIX 1751, if I did take a peek at the Fed fund, let's stay right there with the Tradier Pro software, but I did take a peek at the VIX futures on the CBOE, and I've mentioned this a few times that the VIX doesn't always track the actual spot index. It's more based off of the futures, and the futures, according to the CBOE, in October, the expiration that we're going to look at, the actual monthly expiration, VIX is the symbol as opposed to VIXW. These are the most liquid option contracts, the ones that I like to trade in the most if I'm in the VIX index. Going out 30 days, it's saying that the VIX is at 1890. And so if we look at the 18 strike here, 1750 is where the current market is at. But the 18 strike, if we see the call is trading at 238, and well, actually the 19 is more accurate here. So the call is 212 and the put is 214 just by looking at the ask. Okay. So they're kind of in line. And if you look at it, just a normal option chain, especially on shorter term options, if the stock is at the money, I'm talking about the stock, not an index, usually the call is going to be trading somewhere close to what the put is at. There's some, interest rates and stuff in there that can don't make the math on that perfect. But this implies to me that the VIX is somewhere around 19. I confirmed that by looking at the futures and just saying it's at 1890. And so realize that this is where the October futures are trading, even though the spot is at 1750. Okay. So we're going to be buying the 17 strike call. We're going to then sell 2 of the 22 strike calls, all in that October 16th expiration. And then we're going to stop short, like I said, on the credit side of our butterfly. And we're going to buy the 26 strike. So notice here, from 17 to 22, that is $5, and then from 22 to 26, that is $4. Okay, increases the cost of our butterfly a little bit. We are now paying 76 cents for that butterfly. For example, when we did this trade, now the market was below the 17 strike, and it was different dynamics, but the first trade that we looked at going into September, so we did it at the end of August, we paid the same type of butterfly, and we ended up paying 20 cents and sometimes 30 cents on some of the fills that I got, somewhere between 20 and 30 cents. So we're paying quite a bit more, especially on a percentage basis for this trade. Markets are up a little bit though, with the VIX trading around 18, 19 in that issue. So we're doing this entire trade for 75 cents. It's still cheap, right? If we're buying the 19 strike put, we're paying $2, $2.14 on the ask. So somewhere around $2.10 is where I'd want to look to get filled. We're paying 75 cents. And we have exposure from 17 up to 22. So we've greatly reduced our cost as opposed to just buying options outright. To get to 75 cents, you'd have to go all the way up to the 31 strike call option to pay 75 cents basically for an option contract in the VIX. So butterflies make sense to me in the VIX. That's it, and I'll get off my high horse. Now let's send this to the what if calculator, and I'll try to explain what I was looking at the beginning of the call. Okay, so if I'm going to do this trade, I want this spread to be fairly long, right? So if I'm buying the 17 and it gets all the way up to the 22 on a percentage basis, that's 5 points on a 17-point index. That's a long ways away from where the current market is at or from that strike, because the market's somewhere around here, right? And so this gives this opportunity, if the stock does stay in this range, for these option contracts to decay at a faster rate than obviously we have intrinsic value on that 17 strike call. And that's my ideal goal. I want to be wide enough in my butterfly that if it's hanging somewhere in this range, I get some time decay on this trade. If it continues on up, blows through this, all right, well, then you're in a different spot, in a different situation. But what's really nice is if we did get a huge event and the market ran all the way up above 26 here, we're still profitable on the trade. Well, it's only 25 cents, all right, but they're still talking about the VIX being above 26 and remaining there until that expiration date. But if that is, I'm still going to make 25 cents on this trade. It's not as enticing as the trade that we looked at in August, got to admit, but the VIX is higher. Still setting it up so that we don't have to worry if the market is way up here. We just let it kind of play out. As a matter of fact, if the VIX was trading at 30 and we had 2 or 3 days to go to expiration, I would just let it ride and hope that it comes back and lands somewhere within this range. All right. Do we have any other questions that we have? All right. So here, I think we're going to leave it there. We have 30 days to watch this trade. I have adjusted butterflies in the VIX. It doesn't happen that often. It's more of a trade that I put on, paying 75 cents for this option contract or for this whole strategy. And we're just going to let this ride. If we get that volatility, that spike up, it's at 19 in the futures. If I can get this, if I can sell this for $2, I'm probably going to, especially in the near term. If you want to, if I had, and which I did on my first fixed trade, if you do have 5 or 6 contracts on this, you can trade it. It runs up, you make some money on 3 of them, and then you let the last 3 ride. I like to do that in this fixed trade, especially with this situation where we've stopped short on the butterfly on the upside, and you have a chance for profit no matter where it goes, if it goes above and beyond our short strike, which is the 22 strike. Fairly advanced, but a lot of fun. Might have to watch this video twice. Please give it a thumbs up. Would appreciate that, and share this with your friends. And that's going to be it for this edition of Options Guide TV. We will be back on Wednesday. We'll look at this trade. We'll keep an eye on it and see what's going on with the markets, getting all ready for that Fed funds meeting. And we'll probably end up doing a trade after that. Options Guide TV is before that event. Maybe we'll do something to try to pump up volatility a little bit more. Try to take advantage of some of that increased vol going into that event. Yeah, sounds good. Thanks for stopping by. See you next time on Options Guide TV.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.